Let's talk about Fed policy and more. Joining us now, Roger Ferguson, former vice chair and CNBC contributor. Roger, it is one of the features of this bond market today. The Fed has been cutting rates, and the 10-year really hasn't moved very much. What do you make of that?
Look, I think a couple of things are going on. As Rick just said, where the action is for the Fed, or the expectations from the market in the Fed, is at the 2-year end. I think the 10-year hasn't moved very much, frankly, and further out, in part because inflation expectations haven't moved very much, and inflation itself has been sort of sticky. So I think we're likely to see the kind of flattening that we've been talking about, you and Rick, because the expectations of a Fed easing have, I think, started to come off, and I think that's appropriate.
Market price for 2 rate cuts this year. I think it's a pretty good bet that the new chair will come in and cut rates. And I don't think that's a big deal. I think that's an expectation of the market. But beyond that is where the question is. Roger, yesterday, Jeff Schmidt from Kansas City said, hey, I think we're at neutral. It's hard to find any tightness around. What's your view of whether the Fed, how much more the Fed should be cutting given the economic data we've seen?
Look, I think the economic data does not support an aggressive move down by the Fed. Maybe one more and then done. And 3 things are occurring. One is the labor market data in general have supported the notion of stability in the labor markets. Chair Powell floated that at the last press conference, and I think the most recent data, unemployment, the U3 coming down to 4.3%. The other broader measures of unemployment also coming down. Job creation, robust, primarily in the private sector, by the way, and that's spreading out. Wealth effects still exist. GDP numbers still look like they're going to be strong. So I'd say overall, the message is probably more and more policymakers are going to be comfortable with generally a wait and see kind of approach, as opposed to signaling an aggressive desire to cut further going forward.
Roger, it's Brian. I don't want to go too far back in history, because what's done is done. But we're dealing with inflation now that I think we can all agree the Fed left rates too low for too long during COVID. Most of the economy was roaring when the Fed was acting like it was shut down. I know, because I traveled the country and saw it with my own eyes. But have you also done anything on PPP loan fraud? I know there was a number of years ago, but let's be clear. We're talking about hundreds of billions of dollars of money in some cases that may have gone to people that didn't need it, but they just took it because they could. Any indication of how that has played out to the inflation that we are seeing today?
Look, I'm not sure it's playing out to the inflation we're seeing today. I think, broadly speaking, we have had, from the standpoint of many consumers, different kinds of stimuli for higher net worth individuals. Obviously, the equity markets have been very attractive, and those who own houses have seen a wealth effect there. At the lower ends, obviously, during the pandemic and shortly thereafter, the government was handing out checks for a variety of very, very good reasons. And now we've also seen something else starting to happen, which is the labor market itself may be healing. So I think there are just a number of factors that are going to suggest consumers are in better shape going forward than they have been in the last couple of years. And consequently, disinflationary pressures may not appear as quickly as the Fed is hoping. So all the more reasons is to stand pat.
It's interesting you say that, not only because of Warsh potentially coming in a few months' time, but also, I don't know if you caught David Einhorn's interview with Sarah Eisen yesterday, where he said he thinks because of Warsh coming to the helm that the Fed is going to cut substantially more than 2 times this year. Maybe they will, because Warsh is going to make a productivity case and run it. I don't know. I'm just curious your reaction to that when you talk about the potentially even a stronger consumer that you see coming.
I don't think the data are lining up to allow an aggressive cutting campaign going forward. And we will hear from a number of policymakers. We heard from Schmidt the other day, as Steve just said. So I think the market thinking that Warsh is going to come in and start a productivity campaign to cut rates is, I think, maybe a little bit misguided. The other point to note is people are sort of misremembering history. The last time we had a productivity boom, Alan Greenspan and his Fed refrained from raising rates because they thought the economy could run hotter than had been expected. They did not start an aggressive cutting campaign. And so I think people are sort of misremembering a little bit of history. and perhaps I think boxing Kevin Warsh into a place where he may not be able to deliver a series of rate cuts behind the productivity story, nor a series of rate cuts behind a softening economy story.
What about the labor?
I'm sorry, higher inflation rate.
Just quickly, Roger, and then I'll get right back to you. But what about the labor market? Is it out the window now after the jobs report yesterday, or do you still, look at the jolts, look at some of the data that's been on the weaker side? Would that be the plank for cutting here?
It could be, but this is a very data-dependent Fed, and what's going to happen is, individuals, as Powell has said many times, have their own assessment of the risk they're willing to tolerate. And so just as we've had, quite a few dissents, and in one case going both ways recently, I think an effort to continue to cut rates in the face of the kind of data we've seen thus far, if it holds, importantly, if it holds, will garner a certain number of dissents. And I'm not sure the market's going to be receptive or expecting it. I believe, after the data from yesterday around the labor market, that the expectation of a June cut went under 50%. March cut out the window altogether. And I think that kind of reaction is probably the right reaction.
Roger, the other part of the story that people might misremember that you were specifically a part of is on the tail end of that productivity boom, the Fed ended up raising rates because there was an inflation increase, and that productivity boom, as an investment boom, put upward pressure on capital costs. But what I want to ask you is this question, Roger. If AI causes job losses, should the Fed cut rates in the face of those job losses to make it easier for people to hire people? Or could the Fed have no effect on that because it's AI that's the source and not Fed policy?
Yeah, look, I think you're raising a really important question here, right? Job loss is coming because there's a decline or change in the demand curve for labor. Is not something necessarily the Fed can deal with. What the Fed can deal with is a decline in demand because aggregate demand in the society has gone down. But a change of that type in the labor market where the equilibrium rate has moved is not something the Fed can deal with, and in fact risks stoking inflation. Cutting rates into an economy that's growing well, but is not creating jobs for a variety of technological reasons may not be at all the best move. So I think you figured another important point.
I want to explain what you just said to people from a very simple theoretical standpoint, which is that the Fed theoretically can pick the inflation rate. The economy gives it the unemployment rate or the employment rate, and all the Fed can do is nudge the economy back towards that rate when aggregate demand falls below or above that rate that creates ostensibly a natural rate. So the idea is the Fed can't do much about that, but there's this other side which you were just talking about, which is if you have this productivity boom and it creates downward inflation pressure, the Fed can cut because you have less inflation because of that.
I think that's all fair, but again, I'd be cautious on the Fed can cut. The Fed can refrain from raising rates in what looks like a tight economy if there's a productivity boom. They might be able to cut if inflation comes down as well, but you put your finger on something else, which is the demand for investment starts to go up, which also pushes up interest rates. So it's a much more complicated story. I think viewers should recognize much more nuanced, much more complicated than, productivity's up, hence Fed guaranteed to cut. I just don't think that plays out in reality, and it doesn't play out in theory.